Hello everybody, Dwayne Shepherd here, DRFX Forex Swing Trading. Today I'm going to be giving a preview of an upcoming trading strategy that I'm going to be developing in the next couple of weeks, which will be available to you by the end of June this year. This strategy is going to take advantage of the slow breakout candles that are sometimes seen on the daily chart, which tend to be ignored by swing traders like myself. The reason for this is that these slow candles tend to be followed by sharp reversals, which end up taking away our trades, our trading gains. However, what I've noticed within the last couple of months is that these trades have been associated with significant movements in the market that have allowed traders to capture between 300 to 500 pips. So what it means, having looked at some of these trades within the last couple of weeks, it points to the fact that there are some elements of these trades that can be used in a trading strategy from which we can generate rules and parameters within which to trade these types of breakouts. So that is what I'm going to be working on within the next couple of weeks, so that we'll be able to trade these types of breakouts with the level of confidence required, so that we can sidestep the trades that will lead to sharp reversals and take advantage of those that can lead to those profitable breakouts. Okay, let me start off by taking a look at one of the most recent examples of these types of breakouts. Here we see on the New Zealand Canadian dollar that the pair broke out of this large pennant setup fairly recently. As you would notice, this breakout started with very weak candles, which really do not inspire a lot of confidence if you want to enter short in this trade. However, as you can see, this still led to a very sharp breakout over the next couple of days and led to an overall decline in this market of this pair by just over 400 pips. Taking a look back on this same pair in August of 2014, we see another example of this breakout that took place. These were two pennant setups that were broken, and as you can see here, once again, the candle that actually started the breakout was fairly weak, as were the two bearish candles that followed. Nevertheless, this overall breakout would have offered approximately 500 pips, close to 600 pips. So another example here of a profitable breakout that starts off with weak candles, but slowly but surely moves towards its ultimate target, and can provide several hundred pips for the patient trader. Now, those two examples are in contrast to the types of breakouts and breakout signals that we tend to prefer. Here we see an example of a breakout from a consolidation setup that took place last year, and that was started with a much stronger breakout candle. Zooming in and getting the candles in their right shape here, we can see that this candle is generally the type of candle that we look for, and it was actually one of the trades that I used on a demo account last year that led to the formulation and the methodology which most of you are now using. So this captured 121 pips, and this is one of the smaller trades that we tend to get from breakouts. Usually breakouts offer around 150 to 200 pips in most cases whenever we are trading the breakouts that have these large breakout candles. However, with the smaller breakout candles, they tend to, what I've noticed, provide even larger pips, but over a longer period of time. So the trade-off is that you have to hold out for these trades for a much longer period of time, But the benefit of that is that you are able to capture a significant number of pips that can definitely add to and increase the rate of return on your overall trading portfolio. Let me take another look at another example that arose on another pair last year. Here we see on the Euro Aussie pair that we had a breakout. We had a setup on a range that was broken with a bullish candle as well. However, this candle tended to be on the weaker side relative to what we normally would want from a breakout signal. But once again, we can see that the breakout still took place with these weak candles that offered traders several hundred pips. Taking a look on the other side, we can see that this breakout was actually taken out by another small and slow breakout with small candles that led to an even sharper and profitable breakout. So these are the examples of trades that can be taken despite the fact that their initial signals are associated with weak signals, with weak candles that generally tend to be ignored and can be risky. Taking a look on the New Zealand US dollar, we can see that this pair also had a similar breakout in terms of fairly weak candles. Here we see that this was fairly strong, but these two candles that essentially started the breakout below the uptrend line were fairly small. And as you can see here, this breakout was eventually taken up by a sharp reversal. If you had entered here and placed your stop loss, you would still be in the trade and you'd be enjoying a very handsome floating profit right now. But if you had entered at this weaker candle here, you would have easily been taken out. So this is one of the risks that are associated with weak candles across the market. So the challenge with these setups is gonna be identifying when to enter the trade, the types of setups and signals to look for in deciding on our entry. Second of all, the targets that we're gonna aim for with these types of breakouts. Yes, most of them tend to last for a very long time and provide 300 to probably as high as 600 pips as we saw in the last example. However, one should always want to have a particular target in mind whenever you're trading, regardless of how much the market is actually offering. So this sort of helps to anchor our expectations and anchor our emotions as well, and helps to provide a level of consistency in our trading. If the market is actually going to be breaking out for 500 pips or 600 pips, perhaps a rule could be implemented to initially target 200 pips and then move our stop losses along the way to capture the additional number of pips that are being provided. So that is going to be something that I'm going to be using and implementing in the methodology that I'm going to be providing for you. The other element has to do with the holding period, which is going to be related to the targets that are going to be set. These breakouts tend to last several weeks, and would still one would be tempted to, well, it is possible that in some cases these breakouts last as as few as 10 days to as many as 20 days. However, it is always recommended that you have a specific holding period that again helps to anchor your expectations, anchor your emotions, so that we're not holding out for longer than is necessary to capture pips that won't be there for us. And obviously the stop loss placement is going to be a main element of this trading strategy as well. So these are some of the elements that I'm going to be trying to develop and implement in a strategy. And within the next couple of weeks, you should be able to get a strategy that can add a significant number of pips and rate of return to your existing trading strategy. And by the end of the year, your portfolio should be looking very pretty. So until then, take care.